So I think that we've seen such a dramatic decline in confidence, whether you're talking about CEO confidence or U.S. consumer confidence. Heck, if you're talking about Canadian confidence, we're looking right now at a North American continent that is in recession. And I think that is what we will see in the rearview mirror. We never see real-time economic data reflect what's actually happening on the ground in the economy until after the fact, until revisions come through. But what we're seeing through the prism of revisions is that the U.S. economy was stumbling into the election. There was a burst of energy, a burst of optimism, and now we're seeing a full retracement of that. And whether you're talking about layoff announcements or bankruptcies or corporate earnings or margin squeezes, everything that we're seeing outside of the hardest data tell us that the U.S. economy right now is in a big slowdown.
Yeah, really interesting commentary there. And you've been in the recession camp since October 2023, if I remember correctly. So you obviously still stand by that. What do you hang your head on here? Like, what's the data you're using? You mentioned a couple confidence indicators here. Anything else we should be looking at?
Well, so just to set the record straight, I was in the October 2023, and then we actually saw the rule that I follow the most closely to gauge whether we're in recession or not come out of recession. It was a blip, which came, by the way, on the heels after what we think was a recession in 2022 that wasn't called that recession. But we saw employment begin to heal. And then in April of 2024, everything collapsed again. And through the revisions of negative payroll revisions, one after another that we're getting, it is beginning to look like the U.S. economy, as we speak, has been in recession for about a year now.
Yeah, absolutely. But the question, the data we have to work with and the Fed throws at us, and maybe I'll throw that up here. These the economic projections that the Fed uses and recently shared with us. The economic projections here, change in real GDP. So growth is slowing. I think we can all agree on that. But the unemployment rate is coming down, and PCE inflation is ticking up higher. How does that fit into the narrative here? Like, how do you make sense of all of this? Because apparently, if you just take this data, it's healthy.
Yes, on the surface it is, but if that data reflects reality, then why are 66% of Americans telling us that they expect the unemployment rate to be higher in 12 months' time? We've never seen, and this is the University of Michigan data. This is not a fly-by-night data source. It goes back to 1968. It's the most relied upon, consistent gauge of consumer sentiment. And when you've got 2/3 of Americans anticipating through the prism of that survey that the unemployment rate is going to be rising in a year's time, we've never seen anything north of 60 without the U.S. economy being in recession. Now, granted, the unemployment rate is low. It's only gone from 4.0 to 4.1%. It almost rounded up to 4.2% with the February data. And the Federal Reserve sees it ending 2025 at 4.4%. Well, given what we're seeing with layoffs, right? Challenger Gray and Christmas announced 172,000 layoffs in the month of February. That was the highest going back to the Great Recession. Only 62,000 of those layoffs were attributable to the public sector, meaning the private sector is where we continue to see the greatest amount of job loss. We fully anticipate at QI Research for there to be a much higher unemployment rate than what the Fed anticipates, 4.4%, by the end of 2025. In fact, I think the risk is there that you actually see that 4.4% unemployment rate by the time the Fed meets again on May the 7th. Again, in February, it almost rounded up to 4.2%. Given what we've seen in the layoffs that have been announced and in government job cuts, it's very easy to see that nearly 4.2% going up to 4.3% for March payrolls and 4.4% for April payrolls, which are announced on May the 2nd, 5 days before Jay Powell is next at the podium. 2 full jobs reports that we've got before then, which is why I'm anticipating for there to be yet another Fed pivot.
Oh, okay. I was going to ask you about the unemployment in the public sector, but you just brought up the Fed pivot, and now I'm pivoting a little bit. What do you mean by that? You have to elaborate on the Fed pivot. What do you mean? Are they raising rates?
No, I think the Fed is going to be pivoting and saying it's not going to be 1 or 2 rate cuts in 2025. It's actually going to be 3 or 4 or more rate cuts in 2025, because they are not allowed to ignore their employment mandate just because they have, fears of inflation rising, not rising inflation, but fears of inflation rising, that they anticipate so few rate cuts this year. There is that second employment mandate, and I think they're going to have to pay much more attention to that beginning here with the next coming payrolls report.
Yeah, and you just threw me off there when you said pivot, because the trend was already clear going for 2 rate cuts, but now they would just go harder. I don't know, it's like, for lack of a better term. I'm not sure if there's a technical term for that.
Well,
but
again, Jay Powell has been maintaining that the labor market is solid, that the consumer is strong, that he's not concerned about the U.S. economy. Well, if the Fed's going to be cutting rates more, then he's going to have to change his tune. And that's what I refer to when I say pivot.
Yeah, gotcha. Okay. No, because I thought it was a pivot. Like, everybody was expecting rate cuts, that if you were to pivot, like, are we raising rates? That's been a bit of the discussion. And I think everybody's still trying to figure out whether the Fed is dovish or hawkish after this press conference. I think that's a big question mark. Where do you stand? Do you see him as dovish or hawkish right now?
I see the Fed right now as being rather schizophrenic. So very undecided. You're seeing growth projections come down. You're seeing unemployment rate projections come up, but you're seeing the inflation expectations also rise. And this is a reflection of fears of tariffs, not tariffs that have been imposed. And there's a big difference between the two when you hear the CEO of Walmart, when you hear the CEO of Dollar Tree, when you hear the CEO of Lennar Homes or KB Homes saying, we're having to discount. We're having to discount more than we would like. We're seeing our margins squeezed. We're seeing higher income U.S. consumers trade down to Walmart. We're seeing middle income U.S. consumers trade down to Dollar Tree. That is Federal Reserve officials, not inflation. Those are squeezed margins.
Yeah, no, they will. And there was a really smart question at the press conference there on Wednesday afternoon. It was like, Jerome Powell, when you see the inflation rate ticking up, like, why aren't you raising rates? And I think, and he's been tiptoeing. He's been a fantastic tap dancer at that press conference, I have to admit. It was fun to watch him dance there. Would it even make sense? Is there a case for higher interest rates right now?
Well, not with inflation on a disinflationary track, and that's indeed what we've seen. Whether you're talking about the Cleveland Fed's rent indexes that are showing that shelter prices are coming down. Chair Powell's been referring to that. Whether you're talking about trueflation fell as low as about 1.1%. Now it's up to 1.7% or so. That's telling you that real-time pricing is below the Fed's 2% target. We're seeing core CPI come down. We're seeing services spending in the United States flatline. Now, services has been the source of inflation in the post-pandemic era. We saw a lot of goods inflation. Initially, there was the supply chain disruption. Consumers were buying all kinds of goods with stimulus money, right? We've almost spent $15 trillion is how much the debt has increased to just about, once we hit that $37 trillion mark, we'll have seen $15 trillion in government spending since the pandemic hit. A lot of that manifested in U.S. consumers buying forward goods. And then that became revenge spending, vacation planning, spending on services, higher hotel rates, higher airfares. We're seeing a huge reversal in all of these trends, and services spending come down. And that means that one of the constructs that Chair Powell dreamed up, super services core inflation, that we're seeing that actually begin to decline as well. That's what Powell should have mentioned at the podium. But had he, then the reporter's next question might have been, well, forget about me asking why you're not raising rates. For heaven's sake, why are you only planning on cutting rates 1 or 2 times in 2025? Why aren't you more aggressive on that stance?